I've spent months studying, interviewing, and talking with market makers. And in this video, I'm going to show you 2 ways that institutions use to move markets so you can follow them and make money with them. And by the end of the video, you're going to know what's really going on in these markets and how they actually move. I study them so much that they made me want to become an insider trader. All right, that one might be a joke. But let's dive into the charts and show you exactly how they move the markets. All right, let me dive in and show you guys the charts real quick. Let me just bring this monitor down. Perfect. So how do market makers actually move the market? I'm going to show you method 1. Now, the first one is actually really simple. Second one makes a little bit more sense. I'm going to do that later in the video. But the first one is going to be what I call pullback size. Okay, it's very, very important. Pullback size. Write this down. Now, when it comes to the pullback size, what does it actually mean? Well, a lot of markets actually trend like this, right? They tend to go up and then down, up and down, up and down. Same thing with downtrends, right? They have down, high, lower, high, lower, low, etc. Now, sometimes markets will either push up really, really fast and have very small pullback, just like that. And then other times, markets will move like this and they'll have a really deep pullback and then continue moving higher, okay? The size of that pullback, how deep that pullback comes, is extremely important, okay? Because it shows really important things. Because you guys need to think like stocks are like an auction or like a market, right? Let's say we have an auction, okay? Let me just draw this up here. Let's say we have an auction, okay? And when we're talking about the price of coconuts, and the prices are at 66, and people are at 60, right? So what we find is that the price of coconuts, when they get down to $60, a lot of people buy them. And when price gets up to $66, not a lot of people buy them. A lot of people try and sell their coconut to $66. So what happens is price gets stuck in this range between 66 and 60, okay? Now, if I am someone who is looking to buy coconuts, I want to get them at a discount. Now, what is a discount going to mean? A discount is going to mean when price is, if we draw like a little retracement here from the high to the low, a discount is going to be below that middle or that average price of the coconut. So in this example, I would want to be a buyer anywhere below 63, right? If I can buy it all the way down at 60, great. If I can buy it at 61, 62, perfect, right? But anywhere below 63, you're getting it at a good deal and it's considered better than fair value, okay? Very, very important concept to understand. Now, how does all this tie back into stocks? Where does all this make sense? So institutions, market makers, where do they like to buy? They like to buy at a good deal, right? It would make sense. Just like a coconut, when you're buying a stock, you want to get it at a good deal. So the pullback size is really important. Now, the way that I determine pullback sizes is I use Fibonacci. Now, do I look at like the 0.618, the 0.23? No, none of that matters. I just look at the mid-level from a low to a high. And again, you can counter on this on all different time frames, all different aspects. It works all the same, but I'm just going to do it on a daily time frame so it makes sense for you. But again, all of this applies to day trading, 5 minutes, 1 minute, everything. So quick example on UAL, right? Let's say price goes from this low all the way up to this high. If I'm an institution or someone looking to buy a large position of UAL and we just had a big run up, I'm not going to want to buy. I'm going to want to wait for a pullback. And at the current price and time, if we go from this low to this high, this is considered fair value. It's going to be right at that $38 mark, okay, $38.69. So as a buyer, as someone who's looking to buy this stock, an institution who maybe wants to get filled, 5, 10, 20 million shares of the stock, I want to be able to get in at a good deal. I'm not going to buy high, right? It's classic, buy low, sell high. So the first way you see this is with the retracement, right? Price comes back below the 50% retracement. You now know you are in an area where institutions are going to want to buy, okay? Really, really important. Now, here's where you can actually trade off this and use this to your advantage. Very, very crucial, right? Let's look a little bit further. Let's see what happens here, right? Same thing. Let's say I'm looking to buy UAL. I'm looking to set up a trade. How can I use this in my trading? Well, take a look at this. Quick interruption, guys. I made a free training. I'm going to leave it in the link in the description below. Make sure to check it out at the end of the video because it's going to show you how to become consistently profitable in just 8 weeks. Back to the video. Price goes from all the way at this low all the way up to this high here, right? And then price is consolidating up at this high. Now, this pullback is relatively low, right? From this low to this high, relatively low. We don't go more than 50%. We're still in the upper range, right? We're still in an area where if I'm looking to buy, I don't really want to be buying at this area, right? What I want to be doing is actually buying below this $45 mark, but it never happens. So what happens? Price ends up going and we make a new high, okay? This is really important. Price goes up and we make a new high. Now at this point, this is what I call a bull trap, all right? It's very, very common, very, very common. Because think about what's happening here. We have like the classic bull flag pattern that every, retail trader sees right here, right? You have prices still just made a huge move up all the way up here. So price is very high. Price is not in a good area. It's not in a discount, right? And so you have a lot of retail traders who are buying this breakout of this high, and you basically just have an area where all of these retail traders are buying up here, okay? Now, as you know, as an institution, you want to be selling when that's happening. Same thing with vice versa. Your retail, you want to be selling into strength, right? And so it's a classic bull trap. So when you can see this in advance, when you notice that price has a huge move higher, really important, price has a huge move higher, a small pullback, and then it continues higher, most times that is actually going to be a trap. Okay, this is a trap, and you're going to see price move lower. Because again, the size of the retracement is really important. If this retraces all the way down here, then it would be a better breakout to buy, okay? Just like this one here. We buy this breakout and we go a lot higher, okay? I don't breakout trade, but you guys get the gist. Now, then what happens after this, right? Classic. Price becomes too high. There's an imbalance in supply and demand, so price drops. All the retail traders are selling here, right? It goes below this support, price sells, and all of them are selling. Then what happens? We draw our retracement from the low all the way up to the high. And now, are we in a discount or are we not in a discount? We're way below the 50%. We're a lot lower than we were up here. We're in a discount. This gives us time for institutions to accumulate in this area down here because it's considered a good deal. It's considered better than fair value. And then what happens? Price comes back up way over the high. They buy the breakout and they're selling all the way up here. Why are they selling up there? Because it's a good deal. It's a great deal to buy down here at 40 and sell up here at 56. And then all this comes back in the time frame. You're like, well, why didn't it hold? Why didn't it keep going higher? Again, time frame is perspective. You got to understand when these people are getting in, getting out, and what the overall longer term trend is. Okay, the overall longer term trend could be down. You can see with a quick glance that institutions are buying in this area and they're selling up in this area. Okay, classic support resistance, but using that idea of fair value and what's important is going to help you identify who's in control, right? So number one, just to recap this, we'll go on to number two, retracement size, okay? If you see a deep retracement, that's good. It gives you more opportunity, more confirmation to buy. If we have a large retracement and then a small one, you need to be cautious because if price makes a little move higher, most times it's going to be a bull trap, okay? And they're going to trap a bunch of bulls. They're going to go ahead and bring price lower into a better deal, into a better zone, and then push it back higher. Okay, and you also have a lot of new shorts that are looking to short in this area here, and then they end up getting squeezed out, and that continues driving price higher. It's all the same thing. Okay, so method number two, let's get into it. Now, we talked about retracement sizes. Now, this one is actually really common. It's really simple. Okay, and you've probably already heard it. It's going to be called double tops and double bottoms, but it's actually not what you think. A lot of times it's a fake out, right? So here's a really, really good example. Okay, there's a lot of examples on UAL. This is a really good stock for it. Again, works on all time frames, 1 minute, 5 minute, 10 minute, doesn't matter. I'm just going to use a daily example to make it easy, okay? So what do we see here, UAL? Okay, we see a quote-unquote double bottom, right? Now, they don't have to be exactly the same price, but you can pretty much easily see from this low, it matches up with this low, same with this one. We can also call this a triple bottom if we wanted to, right? We see multiple bottoms in a row. Now, what does that tell us? That is like a classic support resistance area, classic support resistance move. So let's think about this for a second, right? Any retail trader who is buying in this area that at least has common knowledge or brain is going to put their stop loss below the support level. It's very, very common, okay? You can go the whole $1.33 level, right? So we break below that support. It's a very, very common stop loss for all these traders. If I am an institution and I want to get filled a bunch of different shares, well, I need selling. I need liquidity to do that. If I want to get filled 20 million shares on this, I can't just market buy 20 million shares. And I also want to get in at a good deal, right? So what happens? Price drives back below this support level because this is all liquidity. Because again, when price breaks low on this day here, what happens? Every single person that bought down here, that bought up in here, is going to sell. They're going to stop out. They're going to freak out. They're going to sell. They're getting emotional sell, right? That's how retail traders work. So they emotionally sell down here. Then what happens? Institutions are like, oh my God, there's a bunch of people selling all these shares. I'm going to scoop this up. So what do? They accumulate. They buy a bunch of different shares right here. Okay. They buy all of the shares. Because not only are they getting it at a good deal, right? If this was kind of this fair range that we're looking at from here, this high to this low, they're getting it at a really good deal, and they get filled on their liquidity. And how do we know that? Because it's a double bottom. When you see those double bottoms and double tops, it's a very clear sign of support resistance, very clear sign that there is retail activity going on. Okay? So that happens, they buy it, and then they take it all the way back up. And this happens so many different times. So many different times. Here's another example, right? This one's a little bit deeper, right? Same exact thing. We have a bunch of equal lows here. What happens? Anyone, not everyone, but most people who bought anywhere in this area for the past like 5-6 months, they see this massive sell-off. We break support, price goes lower. What happens? Right? They all sell. Everyone starts to panic sell. Everyone is selling up in this area. They're all selling. Who's going to be buying all of that selling? The institutions. Okay, so while this is dumping, they're picking up as many shares as they can, picking all this up, okay? Picking all those shares up, then what do? They bring price back high. Where do they bring it to? Right above that high, okay? Right above that resistance, right above a good deal, right? They can sell it at a good deal. And then what do? They sell off all their shares up here and then do the same thing. Bring it back lower and then bring it back higher. It's all the same thing. When you see these double tops, these double bottoms, they're just taking price from liquidity to one side down to the other, and it's all the same situation. That's how they're able to take advantage of these range-bound markets, not just trending markets as well. And if you're able to identify this, you can easily use this in your trading. If you see a stock that looks like this, for example, if I have a support level here, and I see price kind of just consolidate just like this. We have two double bottoms. We're kind of just consolidating in this range. What can I do? I can easily wait for price to break it, then just wait to see if institutions are actually buying that. And then when price gets back above that support, I can look to buy it and then target all the way up here. It's a classic stop hunt reversal move, and it happens time and time again, right? And you can even look for like a deep retracement in this area too. Like let's say you missed the move, we start to spike up. You just wait for a deep retracement anywhere below that kind of, 50% level mark. And then there you go. You know you're getting in at least at a good deal, right? Because think about it. If you're trading with a risk reward, right? And your target's going to be at that high, your stop loss is going to be that low. If you're getting in even at that 50%, that's a 1-to-1 risk reward, right? Anywhere below that is still going to be a good deal. Not to mention the fact that you can still move your target a little bit higher and have a much better risk reward, right? That's just targeting this high. You can still target a lot higher. Again, all of this comes down to time frame and context and what you're actually trading. A lot of these were all on a daily example, but you can do the same thing on a 1 minute, same thing on a 5 minute. It all works and plays out the exact same. Now, I hope you guys did enjoy this video. What I've done for you is left a free training in the description below. Make sure you check that out because it's going to be helpful for you to become a consistently profitable trader in just 8 weeks. I've done it with multiple students, done it with myself and a lot of other people, and there's a 3-phase system showing you exactly how to do that in the description below. But other than that, guys, subscribe to the video, comment down below other videos I should make, and I'll see you guys in the next video.